Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and just wanted to give you your weekly market update. I am going to go over quite a few things, but so I want to get through them really quick. And we got some feedback like we do every week. But last week we had some people saying, "How can you tell people to go out and buy right now while rates have gone up, inflation is high, market's a little uncertain?" And those sorts of things. So I'd like to explain a little bit further on that, and then get into some of the information that we need to know about what's going on this week in the market. So what happens when you get more of a product? What usually happens? Anybody kind of think back to the Cabbage Patch days, or just think of something new that comes out in the market that everybody wants. What happens is when there's a lot of it, okay, and even a moderate supply, okay, or more of a supply of something, and even a moderate demand or an over demand, we see fluctuations, right, in what the prices may be and availability and all those sorts of things. So in the housing market, when we have a doubling like we've had in the last month or two in the inventory, we look at that and we say, okay, since the inventory has finally, we've been waiting for this, right? We've been waiting for the inventory to go up. Why? That gives buyers more choices, of new and resale homes. And we have to look at, well, why are we getting more of this supply? And what does that mean long term, and all those sorts of things, right? So I get that there's some hesitancy. I also have to bring this up again, and I'm going to stress it 1,000 times. And I'm going to very strongly pose this on you, okay? The Phoenix market is much different than what you will hear about a lot of times in the national news. So we're the number one. We're now the number two market in the area, in the country, number two market in the country. Okay, we rank number two among the hottest housing markets in the U.S. Tampa just went past us on that. Tampa in Florida. Okay, so that's number one. Number two, what usually is a big indicator, for an area for housing? Well, are people moving there? And are there jobs when they get there, right? That's, or there are opportunities to maybe open businesses or get jobs. Now, there's a lot of tech jobs moving here. As a matter of fact, how we're worrying about China going after Taiwan and all that kind of thing? Guess where a lot, not all of it, but guess where a lot or a great majority of those plants or those chips are going to be moving to? A big percentage of them are moving here. Okay, so what does that mean? That means tech jobs. You already are known for being a tech place for tech jobs to come to. Just go on Google. You don't have to take my word for it. Just go on Google and just look up Phoenix area jobs. Okay, just some of the top ones I'm getting if you go to news, in the news feed, it says substantial ROI expected from Center for Advanced, and it goes on to talk about a biocenter, University of Arizona Health Sciences, and also investments in the greater Phoenix area. The Arizona Republic, which is not one of my favorite papers in the world, but as other parts of Arizona see big employment growth, so does Tucson, Yuma, and other places, and so on. It goes into all this. Intel to start recruiting workers this fall for Ohio plants and colleges to kind of go to bring people coming to the Phoenix area. Okay, so we've got 2 million square foot industrial park near Mesa Gateway. Okay, if you know the west side, we know that Westgate is like, it seems like it just continues to expand around the stadium there. It just seems like they're putting in a water park. They're like all these other businesses. We've got Top Golf, all these different things going on around there. It's like everywhere you look, there's construction, okay, and there's building going on of just businesses and jobs being created. Another thing, Sweetwater is bringing in 165 jobs to Glendale. Now hiring 8 Valley companies, now hiring. Okay, this is all just recent news. American Furniture Warehouse opening another store, bringing another couple hundred jobs to the area. You know, we've got, you know, the idea that we've got semiconductors, you know, technicians needed and all these sorts of things. I could go on and on. Okay. So all kinds of manufacturing opportunities too, which is huge, right? We want to have more manufacturing type jobs and good ones, even in tech. Okay. So my point is, if people are moving here and if people are finding jobs here, and if there's businesses and jobs being created here, that's a good sign. All right. And the increase in inventory is a great thing because we wanted more choices for buyers. It also helps to settle down for the buyers opportunities maybe to get more of a normal appraised price on what they're buying, not a super hot frenzy market where there's just such low inventory. Everybody's competing, you know, 10, 20, 30 offers on one house. And, you know, everybody, you know, doing that because of these higher or lower interest rates and low demand. Now we've got higher interest rates, we've got higher supply and a more moderate demand. Yes, because of interest rates, and maybe, you know, we're seeing a little bit of a slowdown, but does that mean we're going into a market crash and we should wait 3 to 6 months, like some people are saying I should be telling people? Well, in my mind, again, I'm going to be buying another property this year, so I'm not worried about it. Number two, rents are going to go up. They're going to continue to go up. As a matter of fact, you know, in the next 2 to 4 years or so, right now our median price in the Phoenix area is about 480. Okay, 480, 490. You know, in about 2 to 4 years or so, we've got 700,000 more jobs coming here. All these people needed to fill these jobs, tech jobs, manufacturing, all this stuff happening. We're going to see a median home price here projected of about 600,000. That's usually, you know, median's usually lower than the average sales prices that we talk about. So when we talk about the average sales price, which I'll get to in a minute, you'll see that that's higher than that median number, right? So median 480 right now, around 480, give or take a little bit. The average sales price this week actually went up from last week. But, you know, we're seeing all these people still coming in, all these jobs coming in, all these manufacturing. So where people will migrate to is where the jobs are. We're not talking about, you know, just Joe Blow jobs. We're talking about, you know, good middle income or upper middle income or higher jobs and opportunities for people. So, you know, to wait would mean you're going to wait. You know, there's a reason why landlords do 1-year leases typically, because they want to raise the rent next year. When you get a mortgage, that payment stays the same. It stays the same. Okay, unless you get into an ARM or something like that. You know, right now we're seeing, you know, with the extra inventory, buyers are giving a little bit more concessions for closing costs. We're seeing things like, you know, temporary buy down rates, 2-in-1 buyer seller programs where maybe, you know, if a seller has to go down $10,000 on a price, that means $50 in the payment for you, maybe 50, 60 bucks for you. But if the seller has to maybe negotiate and pay down your rate, another strategy here, right, for buyers and sellers, then that may actually make a big difference to the buyer now that there's more inventory, okay, a little bit more competition for the sellers, right? But yet we're still in a strong seller's market, but yet it's kind of, you know, we're going into where buyers are getting deals, right? So all this is kind of, you know, bring me to the idea that, you know, a lot of these sellers are, like I mentioned last week, think about this too. A lot of these sellers are, interest rate goes up. It's pretty typical that a lot of, especially short range investors or new investors or people who maybe have second homes, sell off their properties. It's pretty typical. Okay. If you understand history of real estate, and real estate goes up over time, right? So a lot of the sellers that we're seeing, these are people who have second homes. These are people who maybe have invested during, the time when the interest rates were really low, and they got in to do maybe try to play around with the rental market a little bit, or maybe do Airbnbs. Okay. And now they're like, interest rates go up. I've made my money. I'm going to get out while I think the getting's good, right? I think the getting's good. Right. But over time, we know that, real estate will still continue to appreciate, especially again, Phoenix is not your typical real estate market. The Phoenix metro area, at worst, the average would be 5 to 7%. Okay. So that's at worst. That's kind of like our average. The national is going to be more like 3 or 4%. So over time, even short, long term, typically real estate's going to make you money, and it's something you can leverage, right? You don't necessarily have to come up with all that money all at once for that cash, like you do with stock. You got to buy a whole stock or whatever, right? So you lock in your payment, you leverage that, you get, a little bit of a tax incentive and all those sorts of things. So, what my point is that waiting when we know that because we're still going to have inflation, right? People are hurting. There's no doubt about it. But all the more reason to make sure you have a hedge against taxes and inflation, right? So hopefully your income has been going up with inflation, but odds are it probably hasn't, because inflation, when you take into consideration gas, when you take into consideration regular energy for like heating and cooling, or AC units and stuff, which is big here in Arizona, right? And you take into consideration your food costs have gone up. Most people on average across the nation are paying about 25% more in those things, all three of those things combined, right? So if you're getting, a little bit of an increase in pay, that's great, but you're probably not keeping up with it. So all the more reason to have something like, a home that you own, in order to go up with that inflation, right? So yes, we are going to see kind of an easing in the hot, super hot, frenzy, crazy market in real estate, because the rates have gone up along with prices, but the rates are really affecting things even more right at the moment, right? And an influx in this inventory. So great time to get a deal on a property, get a little bit more of an easing on the competition for you, and going after a property right now. Because if you wait, what did the Fed keep telling us is probably going to happen by the end of the year? We're probably going to go up overall. Again, it's not just mortgage rates, but overall, we're probably going to see another, 75 point, hike overall in those basis points. Now, again, that doesn't mean that's exactly how much the mortgage rates are going to go up. Okay. But we're probably going to see mortgage rates go up more also. Okay. In the short to long term. And, I will throw this out there, with our preferred lenders, you're going to get it anywhere from 0.25% from what we're seeing, depending on the type of loan, up to 1% or even more, and better pricing. So keep that in mind. We could probably get you a better rate with our preferred lender. That includes whether you're, buying a resale or even new home. A lot of times, especially with the way the rates are right now, and the fees, okay, that we could probably get you a better deal. And of course, you know how to go out and negotiate in this type of a market for you. Okay. So you got to keep all this in mind, right? We don't just Chicken Little, sky's falling. Oh my God, the rates are, and the guy on the national news who lives in New York City or Detroit is telling me what's going to be happening to me here in Phoenix. Different story, different ballgame. Rates may be close to the same, probably lower with our preferred lender, but our market is completely different than the elites that you're going to be hearing on the mainstream media from LA to New York. All right. Okay. Just the way it is. Okay. We're just a different ball game here in Phoenix. Kind of always have been, at least since the 90s. Okay. When the investors started coming in, because here they could get, back in the 90s, even with super high interest rates, they could get, 4% increase on their investment. Just to give you a quick idea here, we're really spoiled when it comes to interest rates. But really anything under like 6, 7, even under 8, but let's say 6 or 7% is historically really good. because if we look back in the 1970s, it climbed as high as 11. The average was around 9 or a little over 9 in the 80s. Just looking at the notes I got for you guys here today. In 81, the average was 16.6. Yeah, in 81. Yeah, I remember those days when we had to, again, same thing. They had inflation from the Carter days brought in. They had to raise the interest rates temporarily, but then, the rates went down a little bit. In the 90s, the average rate in 1990 was a little over 10%, but it fell. It was dipped below 7. And then it was 6.9 in 1998. In 2000s, went to 8%, and a high, around 5%, 2003. 2009, it was 5%. 2010s, we were, running in the mid 3s by 2012. In 2013, rates went up to 3.9. And then 2014-15 fell back to 3.8. Okay. So, once we hit these bad spots where there is a recession, where there is inflation, inflationary factors, and we hit a recession, like we're basically in one already, eventually those rates will come back down when you're in a bad economy eventually, but they've got to make up the inflation somewhere. And that's always where they end up raising interest rates. And again, it's not just mortgage rates, it's all rates across the board without getting into weeds of that. So, and of course, we know what's gone on in the last couple of years, right? So, if you're going to sit around and wait for that 3% interest rate, you're going to lose a lot of money. Okay. Just bottom line, you're going to lose a lot of money. So I'm just telling you that. You don't have to believe me. You can find out when it happens. But one thing I can guarantee you in the Phoenix area is, our rental prices, probably going to go up another, just in this past year, they went up about 18-19%. Let's cut that in half. So you stick with your tenant and you go up, 9-10% the following year. Your rents are going up and you're not gaining any equity. You have no tax hedge. You have no equity, that you're gaining on the property to fight this inflationary factors that are going on. And homes are going to cost you more and all that. So one of the things, let's run through some of the current numbers here, and I'll get into more of this. One thing I'll leave you with right now is, homeowners' net worth, net worth of homeowners versus renters. Net worth of a homeowner, and again, this is, figured, after about 5 years or so, with the way they're figuring these numbers. But a net worth of most homeowners across the board, when you take them all and you kind of lump them together, right, is going to be about $300,000. Okay. Net worth of a renter is going to be about $8,000. And I think that's a little generous, actually. But that's kind of the latest numbers from 2021. Now, I'll give you one example. I had a couple recently. They unfortunately, split up, got a lot of kids, and the mother is going to be taking those kids on their own, and at least they had, right around that number of equity in there that they were able to divvy. Otherwise, she would have had Zippo. Okay, Zippo. So guys, keep that in mind. Okay, when you're thinking about, should I continue renting or not? It's how people build wealth. Typically, the biggest investment typically that they have is their home. So let's run through some of these numbers here. Kind of get back to some of those sorts of things. Now, last week, we talked about the average sales price. It was $574. This week, it was $589. So, we kind of see these things kind of ebb and flow from week to week a little bit, but that's the average sales price at $589. We are this week at 30-day closed on market. It's been a while since we were at 30 days closed on market, but that's still pretty brisk. Usual escrow period is about 30 to 45 days. So really kind of right in that normal market range. Month supply, we're at 2.07. 2.07. I would say, kind of our typical market here in Phoenix is about 2.5 to 3. That's kind of like a usual market that we've seen before, all the COVID stuff and everything kind of happened. And kind of our overall average, but even heading into COVID, we were a little bit below that 2-month mark. Okay. If we look at the absorption rate, how fast homes are getting under contract, we're at 48.43, which is still pretty heading towards a pretty normal market actually. Average list price is $759. Again, average sales price is $589, and the list to sales price ratio is 99.47. Now, usually we say we like to see that around 98-ish or so. But that means that people are still getting close to 100% of whatever they're listing their home for across the board. Now, the reason why we're seeing the active inventory, or one of the reasons we're seeing our active inventory up, which right now the active inventory is showing at 14,811, is because we're seeing less properties under contract. Why? Got a little bit of the Chicken Little in there. And of course, the interest rates have gone up, of course. Okay. So some people just got priced out of the market, and some people are just kind of wondering what they should do and kind of frozen in place on that interest rate number. Okay. But honestly, with our preferred lender, we haven't really seen overall, haven't really seen gigantic fluctuations in the last few months here in interest rates or anything that's like earth shattering, really. Especially when you take into consideration, someone can put enough down to not worry about MI. That's another factor. Or, bring money over from something else to take care of the MI. So the short sales we had 27 short sales total in the whole market. Nothing earth shattering there. Lender owned REOs were at 15. Again, it's kind of a drop in the bucket. They're up slightly, but we're talking about splitting hairs there, because last week there were like almost nothing, and the week before, so just slightly up. And then the price ranges that we're looking at right now are from up to 449. That's 45% of the market, or 45.86 of the market. From 500 on up to 999, that's 41%. Those numbers are going to pretty much stay pretty close to the same as far as all these percentages go. That's 41% of the market. And then over a million, we're seeing those are at 13.1%, and at 72 days on market in that price range of over a million. Usually that number at 72 days, usually that number is about 3 times that, or almost 3 times that. So again, pretty brisk even there. At the 500 range on up to that, 37 days and 40 days on market below that. So we are in a pretty brisk market still overall, but we did see a little drop in the number of properties under contract the last couple of weeks because of those rates. So that's one of the biggest things I would point out here, is that we a little less, but our properties coming on the market are also really strong. Anything over like 2,500 for the week is meaning we're adding inventory to the market. So that's a good thing. Again, it's good, kind of balance things out a little bit more, less crazy on one side, gives buyers a little bit more opportunity to get in there and get a property under contract and not be competing with so many people, and getting some good deals, getting more towards what really is the appraised value. You take the comparable sales in the area and you kind of average it out. That's kind of just your middle appraised value, average sales price that we'll usually look at your average appraised value, versus what was going on before when you had no inventory, people wanted to buy, and rates were low. If people taking, okay, here's the top of the comps, and I'm going to add 20,000 to that, or even 50,000 to that, and they were getting it. Okay. That's kind of what was happening before. So it was kind of not, something that we usually like to see going on, but it doesn't mean now that we're seeing like, oh, the market's going to crash. We don't see that. Again, in order to really be in our market, to really be in a total level field where you've got to really go out there and really sell some homes, and really work your butt off, or really work to get the buyer some deals. I mean, you're looking at more closer to being around the 30,000 range. And again, during the crash, we were more like 56,000 in supply. So huge differences, different regulations, a lot different times, and a very strong job market here again. So if people want to be here, second strongest market in the country. Some of the things I'd like to make sure our buyers are focused on. And again, you got to be able to afford it. There's no doubt about it. You do have to be able to afford it. Again, I stress you do have to be able to afford it. But can you afford to keep renting? If you don't need to sell and buy, then maybe you second think that and wait till you can get a better rate, or a rate that fits your budget. But as far as continuing to rent, I don't think that's much of a strategy when you look at all the things, all the money you're losing in equity gains. And you're not just paralyzed by looking at the interest rate only. You kind of have to look at all the numbers. You have to look at locking in a price so your rent or your mortgage payment, so to speak, doesn't go up anymore. Just that's your payment and that's it. Even if you didn't have any appreciation, now you're buying down or you're paying down your mortgage. So you've got that equity there. You've also got the appreciation on top of that equity. You do get tax benefits if you choose to take them, of course. And then the quality of life is another thing you should think about too, whether or not you have your own privacy, even if you're just looking at getting a condo or a townhouse, if that's all you can afford, definitely a good way to go. Maybe down the road, you keep that and you rent it out, you Airbnb it down the road. Maybe you pull some of the equity out to go buy a single family home later, or maybe you just sell it off, take all that money and put it into a single family home, or whatever it is that you're looking to do. The fact is, when hard times do hit, I'd rather have more of an inflation hedge than less for taxes and just overall inflation. Okay. So, the Phoenix market, home prices are expected to continue to rise. Rents are expected to go up. AZ, again, is still creating jobs. I can understand people being a little scared and what's going on with the inflation and all that and the interest rates. But again, you got to pay a mortgage every month anyway. You got to pay rent every month anyway. Okay. Rents are going to keep going up. I mean, it's going to be tough for a lot of people to be able to buy a home after about 2 to 4 years from now, when like I said, that median home price is about 600,000. So something to think about. So ways to make money owning a piece of property. Again, appreciation, tax benefits, principal buy down, positive cash flow. You can get rid of that MI up front, that mortgage insurance up front. Then that's great. If you can't, then down the road you do that, and that makes your payment even less of a thing. So positive cash flow, of course, would be if you were to do down the road, rent it out, Airbnb it, or whatnot. So those are just some things to keep in mind and kind of looking at the overall picture. Again, I would never, personally, I would never rent again. But again, everybody's situation, you got to do what's right for you. You got to do what you can afford, and you got to kind of look at the whole picture and get that whole picture for, sit down with, your realtor and, preferred lender and all that, and, see what's going to work best for you. So, there's a saying that says, there's spend time in the market rather than trying to time the market. Okay. And over time, real estate just doesn't lose. So, when we're looking at these things, you kind of have to look at it from that big overall number. Now, We always give you a thing called the Crawford Market Index. The Crawford Market Index, Crawford Report is, they're the people that kind of give us the look at what's going on in the overall market. Right now, we're technically still in a seller's market, but we are at 197. Again, big reason for that is we just have more inventory. We've got this little shift in the market due to these interest rates and stuff, and due to this influx of inventory and people being a little bit, maybe scared or priced out of the market. So 197. Now that number was in the fours before. That brings us to the other idea here that we had mentioned before, that we are in we have a supply issue of, we're at 45.8. All right. So on the supply index, again, if we're at 100, that's the middle of the range. If we're at 110, we're over, into a seller's market. And if we're at below 90, we're in a buyer's market. So overall, we're at 197. Supply index is 45. So, that puts us, like I said last week, that puts us about 60% lower than we want for our supply, and demand is 90.2. Okay, 90.2. So that's still technically in the middle range. Next week, we'll probably see that demand drop a little bit more, I would assume, with the rates. But, a lot of, again, it'll be interesting to see if the supply maintains into the end of next month and into August, because if a lot of these people that are selling off are second homeowners and they are investors and things like that, which we're seeing, a lot of them, when we kind of dig into the data, or maybe, people who don't actually live in the property, or don't live in the property full time, or have out of state addresses and stuff on tax records and things, when we get into our systems, and a high number of them are. It'd be interesting to see what the supply looks like later. And it's typical that once interest rates go up, for people that are investors again, or maybe own second homes, to maybe sell off those properties, because they understand that if interest rates go up, it is going to affect demand, right? It is going to affect demand. So it'd be interesting to see if this supply is transitory, so to speak. Okay. Buckeye right now on the Crawford Market Index has the lowest number on the index of 121. Okay, they just have an overabundance of inventory right now, so they've actually dropped considerably since last month. They dropped 100. They dropped from 171, so they're down 29%. Fountain Hills is the highest at 285 right now. They had a 31% change. They've gone down from 416, 31% change. So that's kind of the highest and lowest on that spectrum. And when we look at some of our contract ratios right now, we can see that we're still over 100 on the Crawford contract ratios. We're still over 100. So that's still, we're like 113. That still puts us in the seller's market again. But if you look at kind of a whole map, without boring you with all the crazy data that we look at, you'd see that it went from a super hot frenzy, basically almost off the charts in some places. And if you could time elapse that, you kind of see how the colors change on a chart. But basically, later or earlier this year, that was much higher. Last year around the same time, I mean, that was like, up near 350. So right now we're at 113. So again, it's just kind of a cooling off, a leveling off due to those rates, and of course the increase in prices too, and overall inflationary factors. People are paying more for everything right now, so just have a little bit less money to work with, and they want to, kind of make sure that they're doing the right thing, and totally understandable. But that's the best information I can give you as far as our local market here in the Phoenix area, what to expect, what we know is going on, where we know where we are, we know what's going to happen, as far as the appreciation and the rise in rents, of course. So guys, I would strongly recommend that if you want more information, you reach out to a good realtor that you know. We'll be happy to help you and go over more of the information and the data. Again, you can always call or text us at 480-788-8569. You can also email us at home@mincolagroup.com, home@mincolagroup.com, or check us out at mincolahomes.com and mincolagroup.com. And make sure you like, share, and follow us. Subscribe to us on all social media, YouTube, Facebook, and Instagram. One other thing I will mention to you, I had this question thrown out at me the other day, like what's the best interest rate you can get right now? As far as just standard, across the board, it's going to fluctuate by the day. But we've seen people getting FHA interest rates in the low to mid to high fours, depending on the day in the week. Last week, there was actually a little bit of a shift. We're seeing in conventional, again, these are just standard average idea. Again, don't quote me, because every day from one morning to the afternoon, it can shift one day to the next, 1 week to the next. But we're seeing low, mid, high fives. And again, some of this will depend on your credit scores and stuff too, for conventional. And then VA and jumbo are obviously going to be basically the same thing. But with our preferred lender, we're seeing, again, anywhere from 0.25%. I've even seen some where people have compared and they're getting over, I don't know how it's happening, but over 1% difference. And again, our preferred lender is, we deal with a broker who shops all the best rates, gets you the best rate, get you some other options that maybe you're not getting out there. They've even had some certain loans where they're able to do those 2-in-1 deals that I talked about, where you can get the seller to pay the rate down for you, or you're able to buy down the rate, of course, which is another thing. But if we're able to negotiate that with the seller, great. That's better than getting the price down overall and a payment. And then there are some special programs where we've even heard as low as 3.75. So guys, please reach out to us, 480-788-8569. Again, mincolahomes.com, mincolagroup.com, and home@mincolagroup.com. Make sure you like, share, and follow us on all social media. And we'll talk to you guys next time. Thanks a lot.